Hey, John Stevenson here, and welcome to the Guaranteed Retirement Guy Show. So, I want to talk to you a little bit about laddering annuities and how to maximize your retirement income. So, when you're thinking about inflation, you're thinking about maybe giving yourself a raise over time. Maybe you're thinking you might need long-term care later on, and you don't want your income to go down, but you want it to go up over time. But you only have a limited amount of money to invest. Usually, when you're thinking about that and you want to make sure you keep pace with inflation, then laddering annuities typically will make sense because you can basically fund, let's say, 3 annuities at a time. So maybe you're 60 or 65 years old and you want to start income right now, but you also want to get raises over time because you want to beat inflation. And you also want to just give yourself more money because you know or anticipate that you'll probably need more later on as you get older. So what you would do is you would fund several annuities at the same time and let them all grow and activate the income streams at different points, which when you do that, you have higher incomes from the same amounts each time. So I'm going to share an example about basically 3 annuities that I'm going to fund, and each of them are going to be for $250,000. So maybe I have a nest egg of $1 million, okay? And I want to make sure that, maybe I don't need much income. Maybe I just need $50,000 a year. And for this particular example, I'm just going to base it off of 50,000, but I'm also going to base that off of me wanting much higher raises than just 3% a year, which I want to beat inflation of 3% a year, but I also want to have more income than that. And so I'm going to take just 75% of my assets because insurance companies don't want it all. They typically want you to have at least 25% in liquid savings. So we're going to take 750,000. We're going to divide it by 3, and we're going to fund 3 separate annuities right now. And then we're going to activate income on one of them in 1 year when I retire, and then another one in 10 years, and then the third one at the 20-year mark. And so that will help me keep pace with inflation and give me the maximum income from my money. All right, so I'm going to share my screen, and you'll notice that I have this at $250,000. I have my age at 65, and I also have my spouse in here. So this is a joint payout, and my spouse is 64 years old. And so what we're looking at is if we defer income for 1 year, so I fund all of 3 of these right now, and then in 1 year, I'm going to retire. I'm going to start taking income. So here's what happens. In 1 year, my first annuity, I'm going to activate that income, and it's going to give me $17,951. And so you notice, and I look at all annuities here. I'm not biased, but I typically look at the highest payout, and I want to make sure they're A-rated as well. Okay, so $17,000, almost $18,000. So that I'm going to start taking income right now. I have enough money coming in from Social Security, and with this, I'm covered. Okay, so in 10 years, though, I'm going to need more because Social Security is only going to go up probably an average of 2% a year, and this other payment stays at the $18,000 a year. So now my second annuity that I funded for $250,000, I'm going to activate that income on year 10, which that's going to give me a significant raise. Now it's going to give me $38,679 a year for the rest of my life. Okay. And if you don't want it in the same company, you can have it in different companies. You got North American and Midland here who are close second and thirds. So they're pretty darn close as far as income. So I'm turning on the income, $38,679, which is great. I'm keeping pace. I'm beating inflation, actually. And so I'm living life. Things are going great. My income is where it needs to be. And then in another 10 years, on the 20-year mark, which I'm now 85 years old, I want to activate the third annuity. And maybe I'll need it for long-term care for myself, or maybe I passed away by then, but my wife needs it. Maybe she needs it for long-term care, or maybe she wants to travel. Maybe she wants extra money because she wants to do an elective medical procedure. There's all these things we don't think about that we think, oh, my house is paid off. I'm great. I don't need more income. But we don't think about all the future scenarios where we would probably need more money and we would want it if we had it. So in this scenario, me or my wife, or jointly, we're both alive, we activate this third annuity at age 85 and 84. And now that same $250,000, which was invested 20 years ago, is now going to give us a guaranteed amount of $56,000 a year for the rest of our life. That's pretty phenomenal. So again, we're giving ourselves raises, and that's allowing us to keep pace and beat inflation. So let me show you another chart here so you can actually see a breakdown of how this looks. So here's what I did. My current job, let's say I'm making $80,000 a year, and that's what I'm making this year. And then I fund all three of my annuities. So I fund them all, and they're all sitting there, and they're all growing and ready to go. So at age 66, my Social Security is going to be $34,000 a year. And you notice this column, it goes up. It goes up because typically Social Security will go up around 2% on average. At least that's what we've seen on average. And so I have that. But then I have my first annuity. My first annuity, remember, I funded that for $250,000. So I activate that income, $17,951 for the rest of my life. That gives me total income of $51,500, which is what I need. Now, you'll notice that over the first few years, this actually erodes a little bit as far as keeping pace with 3% inflation. So if you want to make sure that you're keeping pace with a 3% inflation, maybe the first annuity, you can put an extra 50 grand in there. So maybe make that first annuity 300 grand to beat this scenario. But you don't have to. If you're okay with it rising to around $65,000 during the next 10 years, then you're okay. And so then what happens is, of course, at the 10-year mark, now I'm activating the second annuity that I paid $250,000 for as well. But of course, you can see the income is now $38,679. So that combined with the first annuity and Social Security, now my total annual income is $95,000. My total desired income with the 3% inflation is $67,000. So I'm beating that by almost $20,000. That's pretty good. Actually, sorry, $28,000. So really good. Now, I'm living life. Things are going good. You can see that this is slowly going up just because Social Security is going up. But again, there comes a point where that's starting to erode in value, and I want to give myself another raise. So on the 20-year mark, I'm going to activate my third and final annuity, the one that I, of course, paid $250,000 for 20 years ago. But now the income is $56,044, and that now brings my total income to $157,790. And of course, that raises every year after that just because Social Security is going up. But it doesn't matter. At that point, I'm making $158,000. My need is $93,000. But you know what? Maybe my need is much more because maybe I need long-term care. Maybe my spouse needs long-term care. Maybe there's a hip surgery that I need, and I would rather get it from a certain doctor versus another, but my insurance won't cover it. But now that I have all this extra money coming in, I can afford it. I can afford to do what I want. So something to think about. You're using annuities to ensure your future income needs. Okay, we don't know what's going to happen in the future. We don't know where we will be health-wise, but you have to prepare for it. You have to plan for it. It's just like life insurance and health insurance and car insurance. You're planning for a potential huge cost, a disaster, or a loss, and you have to make sure you cover it. And so with annuity laddering, it allows you to beat inflation, allows you to give raises to yourself, and allows you to build in multiple income streams so that if you need it for long-term care or if you just need it for traveling or whatever, you can have it. And you don't have to worry about going into poverty as you get older and just making do or maybe moving in with your kids. Now you can continue to have higher and higher in income. And of course, that is because you set up your annuities right in the beginning. Okay. So if that's something you want me to take a look at, go ahead and book a call. You'll notice that there is a link at the bottom of this video. And of course, just go directly to my calendar and we can take 30 minutes and go over your specific situation, your questions, and what you're looking for. So I can build out a customized strategy just for you, and I'm happy to do it. So thanks again for watching, and we'll see you in the next video.